Hey, good morning, Justin.
Good morning.
Let's see, Leah is here. Good to see Leah, or really see her name. Hi, Katie. Katie's the one who must type her answers to us. Good to have you, Katie. Rachel, you've come back. I guess we can get started in a moment here. There's Rachel. How you doing, Rachel? Nice to see a face. I work better with an audience face to face. When I'm at the comedy club here. Okay, let's. Whoa, excuse me. I need a schnorter. All right, let's get started here. Good morning, Vanessa. We're going to go into chapter 3. Chapter 3. I covered chapter 1 in the lecture where we had the orientation. And then Wednesday, I went into chapter 1 briefly and chapter 2 in some detail. So if you want to get back into chapter 2, I have that total lecture set up in Canvas for you. But I'd like to get into chapter 3, which is where we get into the words of debit and credit, and things start getting a little more challenging. Okay. Now in chapter 2, we went over various transactions. And hold on one second here. Share. You can see the screen, Justin? Anybody?
Yes, everything looks good.
Thank you.
Of course.
The problem is sometimes I've sat here for a whole hour lecturing and not realized nobody's seeing the screen. I want to avoid that fiasco. Okay, so now we're going to get into something called double entry framework, where you're going to learn that every transaction requires 2 items. It requires a debit and a credit. So let's have a little fun with this. We're going to talk about what's called a T account. A T account is really mimicking your general ledger. General ledger is the books of the company, okay? And you have a T account for every item in your chart of accounts. In other words, cash, accounts receivable, accounts payable, rent expense. Each of these things will be represented by what's called a T account, and it mimics your general ledger. And we want to understand how to maneuver around a T account to get started. T account, look at that, huh? Debit, credit. Debit, credit. Debit on the left, credit on the right. That's the first thing you'll understand, hopefully. Debit on the left, credit on the right. The only thing debit and credit means is left and right. Left and right, that's all it means. You're going to have a T account, like I said, for every single item in your chart of accounts. DRCR, abbreviations for debit and credit, you'll see. Cash, you're going to have one for cash. And you'll look in your general ledger, and there it is. You'll see cash. And on the left, you'll see a bunch of numbers under the debit side and a bunch of numbers under the credit side. Every T account has an increase side and a decrease side, okay? Some accounts increase on the debit side and some on the credit side. Ergo, the confusion. And this is what's going to drive you nuts for just a little bit until you do some homework and get it in your skulls. The debit side's always on the left, credit's on the right. So some accounts are increased with the debit, some are increased with a credit, and you just have to know those rules. You have to know those rules to an absolute empirical certainty, okay? So let's see what happens with a T account. Ooh, we got a T account. Hey, look at that, cash. Cash. You see debits on the left total $3,500. Credits on the right total $3,130. Okay, that means that the debits are higher than the credits. So the balance in this account is going to be 3,500 minus the 3,130. So your balance is going to be $370. Okay. Cash is an asset, and assets increase with a debit. You have a debit balance of $370. Cash is increasing on the debit side, decreasing on the credit side. So that first $2,000 you see there, that might be somebody starting the business. And then the person went out and bought some motor scooters, then went out and bought some more things. Then he had a sale of 500, more sale, etc. So a T account, that's going to be your friend, and it's going to be a way to organize data as you go forward into this course and in 230. Okay, describe the effects of debits and credits on specific types of accounts. To debit an account means to enter an amount on the left. To credit account means on the right. And as we're starting to learn, debits may increase or decrease the balance of a specific account, as do credits. You're going to learn, for example, that accounts payable and all liabilities are increased with a credit. So let's keep going and see if we can conquer this. Assets. Remember our accounting equation. Assets equal liabilities plus equity. Assets increase on the debit side. Assets increase on the debit side. That's all I can tell you. Assets increase on the debit side. That is called the normal balance of the account. An asset has a normal debit balance. If you have a cash account at the end of the month and you have a credit balance, there's something wrong. Somebody has stolen money. There's an unrecorded transaction. You made a mistake of some kind, or you're floating checks. But you can't have a credit balance for assets, okay? Not without a real good explanation. Assets equal liabilities plus equity. Look at your liabilities, your accounts payable, your notes payable, your rent payable, taxes payable, interest payable. All those different liabilities increase on the credit side. Increase on the credit side. So the normal balance, and that's an accounting term, the normal balance of a liability is a credit. Owner's capital or owner's equity, or the net worth of the business, increases on the credit side. Maybe you can start to try to memorize these rules this way. If you know assets increase with a debit and assets equal liabilities plus equity, liabilities and equity would have to go up with a credit, okay? And this could be a lot of what's in your homework, what's in your exercises, a lot of test questions on this. This is the area where I really like you to get comfortable. It'll make your life a lot easier going forward. We have two other things, revenues and expenses, and I guess drawings. Revenues increase on the credit side. Revenues increase on the credit side. Revenues have a normal credit balance, just like capital and liability accounts. Then we just have expenses, which increase on the debit side. Increase on the debit side. So expenses have a normal debit balance, just like assets. And then you have the withdrawals. The withdrawals are the drawing, that has a debit balance. You're going to need to know this for the next two chapters. And then after this, you're not going to see drawing or withdrawals again. But we need to know it. Drawings have a debit balance because they reduce the equity. Increases on the debit side, just like assets and expenses. And here we're going to look at a couple ways to help you to maybe learn this stuff. The accounting equation and the owner's equity umbrella. Isn't it nice to have an umbrella? What impacts owner's equity? Revenues. Whenever you have a revenue, it increases the equity. When you have an expense, it decreases the equity, and so does drawing. Assets have a debit balance normally, normal debit balance. Equity and liabilities would have the opposite, credit and credit. I would take a picture of this screen and maybe have it in your wallet, carry it around with you. Notice they list assets, liabilities, owner's capital or owner's equity, revenues, expenses, and drawing. It says increase, decrease. You don't have to worry about memorizing 3 columns. Just memorize one. Memorize the increase column if you like, or the normal balance. Maybe the normal balance is the one to look at. Assets have a normal debit balance. Liabilities and equity credit, revenue credit, expenses debit, drawing debit. Or the increase, memorize the increase. It's the same thing. It's going to be the same thing as the normal balance. Assets are increased with a debit. Liabilities, equity, revenues increased with a credit. Expenses and drawings increased with a debit. Now we're going to fool around with the T accounts to do some transactions, huh? And just like in chapter 2, they're telling you what happened. Make sure you understand the event that's just taken place, huh? What's taking place? Well, we got to process the payroll. That requires a huge journal entry. Okay, what accounts are affected? Well, salaries expense for sure in cash. How is the accounting equation affected? Okay, so we're going to look at pretty much the same transactions we did with chapter 2, only now we're putting them into the world of accounting, bookkeeping. Mitchell invested $5,000 in his business. What are the accounts that are affected? Well, he put $5,000 in his business, so his business is now capitalized for $5,000. Cash is an asset. Williams Capital is owner's equity. So let's see here. This transaction is going to increase an asset and increase owner's equity. So we're going to debit cash and credit Williams Capital for $5,000. And there it is in T account form. We now have a business worth $5,000. Purchased an asset, excuse me, for cash. Purchased an asset, a motor scooter for $2,000 cash. Okay, let's think about this. Well, we know cash is going down, and we know we have another asset in place of it called delivery equipment. Classify these assets or assets, liabilities, whatever. Cash is an asset, and so is delivery equipment. So Mitchell exchanged one asset for another. He gave up $2,000 in cash for a $2,000 piece of equipment. And there you go. Notice you have a separate T account for every item in your chart of accounts. Your chart of accounts means the list of the items that you choose to put into a folder, like a T account. He bought something on account. Remember the magic words, on account, and nobody had money. So as soon as you see on account, you know it's going to be accounts payable or accounts receivable. So he bought a second motor scooter on account for $1,800. Well, let's see. He got some delivery equipment, but we know nobody had cash, so it has to be a bill he's going to pay later. So we're going to have delivery equipment going up and accounts payable going up. So let's see. We have an asset and a liability. We're going to debit delivery equipment and credit accounts payable. And here we go. He's got another item he bought just now. and he's up to $6,800, right? Up to $6,800. And as we go forward through the class, we're not going to use the words increase, decrease that much, plus, minus, more or less. We're going to say debit, credit, and you just have to know those rules. I just had a class where I had maybe a half dozen students out of a big class, about 40, who never did any homework and and they had no idea at the end of the course what the debits and credits were all about. So naturally they failed. And normally I don't like to fail anybody in 110. But if you don't know the debits and credits, that's a good way to lose track here. Now we have a payment on account. Now we're paying down some of that bill. And the accounts that are affected, of course, are going to be cash, accounts payable. So we are going to decrease these two things, I guess, huh? We're going to credit cash. We're going to reduce cash with a credit, and we're going to reduce the liability with a debit. Debit. And here we're looking at it. Notice we had an $1,800 purchase on account, accounts payable. And now we just paid down 1/3 of it for a balance of $1,200. And our accounting equation is in order. I don't think I mentioned this too clearly. Every transaction, accounting transaction, requires at least one debit and one credit. You can have one debit and a ton of credits, or you can have 100 debits and one credit, but you have to have at least one debit and one credit. That's why it's called double entry accounting. Okay, he delivered some pizzas, and this time he got cash. Oh, that's great. Cash goes up, and so did our revenues. Cash went up, and so did our revenues. We're learning now that cash is an asset, which increases on the debit side. So naturally, delivery fees increase on the credit side. So now he has some revenue. Now his equity has gone from 5,000 to begin with, plus the 21. Now his equity is up to 7,100. Okay. Equity just went up. Oh no, we got to pay the rent. He paid 1,000 in rent. Cash is going to go down with a credit. Rent expense goes up with the debit. We're going to debit rent expense and credit cash. And when you're talking about a journal entry, which is the means of inputting this data, you always start with the debit. So normally you say debit, then the credit. Not a hard and fast rule, but that's how people will expect you to speak, okay? So rent expense is $1,000. So that's going to decrease. Look at that. Our equity went down to 6,100. We had 5 to begin with, plus these sales of 2,100. That's 7,100 minus the 1,000. And our cash balance is now $7,300. And we still owe the 1,200 in accounts payable. Paid the phone bill. It's another expense. Cash is certainly going to be one of the accounts to worry about. And guess what? Telephone expense. Decrease the asset and increase the expense. So we're going to debit phone expense for 100 and credit cash. Debit phone expense, credit cash 100. Okay. Delivery revenues on account. Okay, on account, which means no cash. On account and nobody had money. Mitch made deliveries on account for 2,400. He catered a big meeting here at City College, and he brought the food in, $2,400 worth of stuff, and he handed the dean the bill for 2,400 to be paid later. So we know we earned revenues. That's what we do for a living. We deliver things, and we are going to get paid later. So it's accounts receivable. We're the ones to be paid. Try not to, don't go too fast when you see on account. Make sure you're clear whether it's accounts receivable, we're getting the money eventually, or we're paying it later, accounts payable. So revenues are recognized when they're earned. So we are able to claim that income now. We are claiming that revenue now. That's a GAAP rule. You record revenues, expenses when they take place. It has nothing to do with when the money changes hands. So we're going to debit accounts receivable to increase it, and we're going to increase our revenues, called delivery fees, for $2,400. $2,400. He bought supplies for $80, and these supplies are going to last a while. So we're not going to call it an expense yet. We're going to call it an asset called supplies. So one asset went up, supplies, and cash went down. Maybe see it a little better. And now we have the supplies added in here. You notice that the supplies, when they added it to this row, they put it after the accounts receivable and above the delivery equipment. You're going to be learning pretty soon that these are called current assets, and things like equipment are called fixed asset, non-current assets. Okay, remember that money, we earned $2,400 on account, and we debited accounts receivable, and we credited revenues. Now the customer is going to pay part of the bill. So Mitch received cash, but this transaction has no impact on revenue since revenue was already recorded. You record the revenue when the sale takes place. Now we're just getting the reward for it. We're going to have to do something with cash. We're going to have to increase cash, decrease receivables. They're both assets. Assets have a normal debit balance. So cash will be debited. Accounts receivable will be credited. And here we go. Bringing in a ton of cash now. He's got $5,220 in cash. Assets equal $9,600 plus $1,200 in liabilities. Owner's equity, 72. That is called the accounting equation, in balance. Now here we go with the more complicated thing. We purchased an asset on credit. Again, when you see on credit, you know there's no cash involved normally, but they did make a partial payment. So he bought a new motor scooter for $1,000, huh? Okay, so we know that equipment is going to go up, motor scooters, and he made a down payment of $3,000, and we're going to pay the rest over the next 4 months. So let's sort it out. We bought delivery equipment. Well, that's going to go up by $1,000. Cash is going to go down by $300, and accounts payable is going to go up. Now that we know our debits and credits, we can say we're going to debit delivery equipment $4,000, credit cash $300, which increases it, and debit cash $300, which increases it, and credit accounts payable, which increases the liability. And they're breaking it out again for us to look at. And he's got an interesting little business going here. He's generated some cash, and he's got pretty good income so far. We got to buy insurance. By definition, whenever you buy an insurance policy, you're buying an asset. An asset. An insurance policy does not become an expense until we receive the benefit of it. So in this case, Mitchell paid $700 for an insurance policy. The asset, prepaid insurance, increases and cash decreases. You buy an insurance policy in December, but you're not covered, say, until January. So when you bought it in December, it's an asset. When you go 1 month in January, hopefully you didn't use the policy, you got the benefit of it, and then you've got some expense. And we'll take a peek here. Delivery equipment. Hold on 1 second here. Oh, we bought the pre, I forgot what the transaction was. Forgot to look at the color, the blue. Prepaid insurance goes up, that asset goes up with the debit, and we credit cash. Wages, they represent an expense. He paid his part-time employees $1,650. That's an expense. We're gonna debit that. And let's call it wages expense. And we're paying the people right now. So cash is gonna be credited, is gonna go down with the credit. Wages expense up with the debit. Cash normal balance is a credit. And there we go. We added a new expense here, wages expense, took it out of the cash. And now we have a delivery made partially on account, partially in cash. So total deliveries for the remainder of the month amounted to $3,500, $900 in cash, $2,600 on account. Okay, on account means it's going to be accounts receivable or accounts payable. Here, we are delivering goods for which we're going to be paid later. So it's clearly accounts receivable. So let's see here. Delivery fees were $3,500. Well, cash is going to go up. Cash will be debited $900. Accounts receivable debited $2,600. And delivery fees would be credited for $3,500. All of these increases. All of those are increasing transactions. And then lastly, with the transactions, Mitchell withdrew $3,000 from the business. A withdrawal is a personal drawing by the owner. The owner comes to you. The owner comes to you and he says, please, I'd like you to give me a check for $1,000. And you say, sure, boss, where do I code this? And he says, it's my personal business. I'm going to San Diego today and I need a few dollars to do something on my own. Well, you know, it's a withdrawal. You know that reduced the equity in the business. It reduced the equity in the business. This business is now worth $3,000 less than it did before. A withdrawal, a drawing, same thing. They are not expenses. They are reductions of your equity. So I'd like you to give a little bit of look at this section over here now. We started off with revenue of $5,000. I'm sorry, let me start again. We started off with an investment of $5,000 to get the business going. And then this company brought in various revenues and it brought in various expenses. The revenues increase capital, expenses decrease capital. Drawings have a debit balance, therefore, they also reduce capital. So at the end of the month, this right now, if this was the end of the month, this guy's capital would be 5 plus 8 is 13, minus these expenses, minus the drawing. Now, let's go back to our financial statements for the second time, okay? Let's take a look at this. Prepare a trial balance. Hold on one second. Okay, good. Just wanted to check something coming up. We're going to prepare now what's called a trial balance. The trial balance is a listing of all of the balances of all your accounts, debits on the left, credits on the right. That's all it is. You're going to see cash, debit balance, accounts receivable, debit balance, accounts payable, $300 credit balance. The only thing the trial balance does for us is tell us that our debits equal the credits and that we are in balance, okay? That used to be a problem when I had to do this stuff in pencil. You can make a mistake and next thing you know, you foot your trial balance and you're out of balance. It'd be terrible. In this age today, no accounting system will let you post an unbalanced entry. So I don't think you have to worry about it. But the real other purpose of a trial balance, it's a tool from which we can prepare the financial statements. So the trial balance just proves that the debits equal the credits. The equation is in balance. And it's typically prepared at month end. Month end. You come to work on March 1st, you're the accounting people. The first thing someone's going to do is run a trial balance. And then you're going to start doing your analysis for month end, or start doing the financials perhaps. So the trial balance, you pretty much print it out whenever you want, but month end typically. By totaling of debits and credits, equality can be tested, we're in balance. And the trial balance is not a formal statement. It's a piece of scrap paper, really. Only the accounting people make use of it. It's used as an aid in preparing the financial statements, and that's an important thing to understand, okay? It's used as an aid. Nobody in the history of investing has ever come to you, to a company, and said, I want to see your trial balance. It just doesn't make any sense, okay? The trial balance is listed in a particular order, and you should start understanding this now. Assets, liabilities, equity, revenues, expenses. Assets, liabilities, equity, revenues, expenses. In other words, it starts with the accounting equation. Assets, liabilities, equity, revenues, expenses. They are going to be listed in that order, and that's very, very important to understand. And take a look at the trial balance. Look at the trial balance. Well, the first thing, we can look at the bottom, 14,900, 14,900, that adds up, huh? We're in balance. So that seems like a good thing. Where did we get these numbers? Where did we get this $470, for example, for cash, and the $3,100 for accounts receivable? We got them right from the general ledger. Here's your 470. Here's your 3,100, your 80, your 700. Here are the others. So they come right from the general ledger. Okay, now we have the trial balance, assuming there's no adjustments to be made, which is impossible, but for now we're pretending that no adjustments are going to be made. It's time to prepare our financial statements. The bosses were all anxious to see if we made any money. So you take the trial balance, and we're going to start doing something. Now, I'm not sure how helpful this is, but what they're doing with these colors is telling you that the blues go together, the yellow, the tan, gray, whatever. The blue, obviously, are the assets. Liabilities are 1,900, capital is 5, drawing is 3, revenues, expenses. They're just breaking out the order for you. They're telling you that the assets are the blue and the colors hold up after that, okay? I'm not sure how helpful that might be. But let's take a look at it. We're ready to do the financial statements. And the financial statements must be done in the proper order. You cannot do them otherwise. You must start with the income statement, followed up by the statement of equity. Finally, you do the balance sheet, which is really a recitation of the accounting equation. I'm going to give you the Bob Smagula tip here. You see where it says delivery fees and drawing? Draw a horizontal line. As soon as you get a trial balance, draw a horizontal line separating the drawing and the delivery fees, separating the capital and delivery fees. The reason I say that is because everything below that line is going to be your balance sheet. Everything above it's going to be, I'm sorry, I said that wrong. I made that great, had some good momentum on there, and then I botched it up. Everything below that line is your income statement. Income statement. Everything above that line is going to go on the balance sheet. So that might help you avoid some confusion. So look at this. They're doing the income statement. And we can see that the income was the revenues were 8,000, and then we had 1,116.50, huh? And how easy is that? There's your income statement. You start with the name of the company, because this is a formal financial statement. This will be seen by the public. This will be proffered to potential buyers, investors, and lenders. So it needs to look right. Revenue, 8,000. 3 expenses, 1,650, 100, 2750. Net income of 5,250. He made the same exact profit he made in chapter 2, over 60%. Now that we have the income statement, we can prepare the second of the 3 statements, which is the statement of owner's equity. Owner's equity. And this one here is, I'm going to use the word simply, is simply beginning balance plus net income minus drawing equals ending. You got to bide your time. BIDE, if you like mnemonics like that. Bide, BIDE, you bide your time with an equity statement. You start with the beginning, which is this investment of $5,000 plus the net income of $5,250. And Mitchell withdrew 3,000. Perhaps that's going to be his salary. He's paying himself. So the capital went up that amount, and there's your ending. Beginning, net income plus, drawing minus, ending. There is your ending equity number. Ending equity number. Let's have some fun. Oops, this thing doesn't want to move on me. Hold on. We're back to the trial balance. We're just going to copy when we do the balance sheet. When we do the balance sheet now, we're just copying every single number from the general ledger, except one number has changed. What number has changed from the trial balance? The answer is the equity number. The equity number. Okay, because when we began the business, we had equity of, what was it? $5,000, capital 5,000. That number has now changed to 7,250. So there's your balance sheet. 9,150 in assets equals 9,150 liabilities and equity. And this is what and this is what we're used to do a lot of analysis. You're going to look at that accounts receivable number as the accounting department, and you're going to determine how many days of receivables those represent. How soon are we turning our product over? Are we efficient collecting receivables, supplies? You're going to go through all of these and do some analysis, discussions, meetings, and other worthy projects. Now that is the end of today's lecture. Does anybody have anything to say? Any questions, comments? I've been doing all the talking. Who wants to say something? Nobody? Okay. What do you think, Leah? Making some sense? No, Leah.
Yes, sorry, am I unmuted?
Yeah,
Yes,
you're-
thank you.
Okay.
Very helpful coming in. And can I bother you to for a reminder where I could find these, the recorded versions? I missed chapter
same.
2.
Find me
here.
for, say that again, Vanessa? I didn't hear what you said.
Lee was asking where we could find the recorded versions.
Oh, these are put up on 2 places. This will be up on Canvas in a couple hours. So on Canvas, and you can always go to my great website, the Bob Smigula website, and you'll see all my golden oldies up there, and you can pick out the items, okay?
Perfect.
All right, I guess we'll take off then. You take care, everybody. Thank you.
Thanks,
Thank you
Bob.
so much. Have a great weekend, Bob.
Got
See
a
you
great
next week.
audience.
Thanks.
Bye-bye.